Hi, this is Mitch Allen with the Advanced Financial Alpha Team bringing you another video today. We're going to talk about required minimum distributions, otherwise known as RMDs. The Secure Act 2.0 actually changed the ages in which you had to start taking these distributions. Essentially, what it was is either 401k or IRA money that has been tax deferred over the years. Government says, hey, you got to start taking this money out and pay us some taxes. We need to get some tax revenue from this. So they set an age in retirement in which you have to take money out of these accounts and pay taxes on them. And what it's based on of is life expectancy factors, which is a percentage of your overall nest egg. So if you look at the screen I have shared here, this is actually an RMD table. Currently, those born before 1960 have to start RMDs at age 73. All right. So if you look at that, your factor is 26.5 or 3.77% of your nest egg. Easy numbers, right? $1 million, that's 37,700 each year, or that year that you have to take out, and that percentage increases each year as you get older. All right. And the factor then is based off of the previous year's ending value on 12/31 of the previous year. So those taking an RMD this year for age 73, we would look at 12/31 of 2024. What is the value of all IRA and 401k money, any qualified assets other than Roth, and calculate out based on that percentage what they'd have to take out and pay taxes on. Now, the issue comes in when a client, say, this $1 million client, right, has to take out 37,000 plus, but they only need 20,000, right? Well, that additional 17,000 that they are forced to take out and pay taxes on, what do they do with it? Well, there's different strategies you can use with that. Qualified charitable distributions, which you can actually start doing at age 7, the year you turn 70 and a half. Distribution from these qualified assets that go directly to the charity, and then you report them as a qualified charitable distribution so that you can deduct the full amount above your standard deduction in case you can't itemize. You can continue to do that past the age of 70 and a half. All right. That's one way to try and cut that tax burden down, is by being a philanthropist and donating to charity. Another way is you can preemptively try to take care of this by doing Roth conversions. At least in this case, you can, prior to age 73 and even after, look at doing a conversion of a portion of those assets. That way you can control the amount of taxes that you're paying each year, which will then cut down on future required minimum distributions. All right. And that should be calculated each year and on an ongoing basis if you decide to go that route. The reason is because Roth dollars don't follow the same pretense to have required minimum distributions taken out. The other strategy then, if you don't need the money, right, is you can take the distribution, pay the taxes on it, and then reinvest in a taxable account, or fund 529 plans for grandkids or children. But even in the majority of those scenarios, other than the QCDs, you're paying taxes on that additional amount that you're taking out. So planning ahead before this happens, whether that be while in your saving years, maybe putting a small portion towards Roth, not just pre-tax, which I've talked in another video that I did, Roth versus traditional, or doing these conversions or QCDs, can really help down the road. A big issue with RMDs is not just that you have to take out this increasing percentage. What typically happens is one spouse for a married filing jointly couple will pass away. Couples don't typically pass away at the same time. It's pretty rare that that happens. So what you have then is the surviving spouse inherits those IRAs, but is still required to take the required minimum distributions. But now they're filing single as a taxpayer. So their tax bracket rises drastically. Those RMDs continue to increase, but now they're paying even higher taxes on them. On top of that, when money passes on to the next generation, the old rules allowed you to take required minimum distributions based on your life expectancy, whatever age you were. Now you're required to take those out in 10 years. I've had conflicting reports on if you have to take like a 10% distribution each year, or if you can wait and just take it out as a lump sum at some point. But the point is, it has to be completely withdrawn in 10 years and taxes have to be paid. What happens usually is the child is inheriting that money in their higher income earning years. They're forced to take these distributions, which bumps them up into higher tax brackets. If one of your goals is to pay less in taxes, period, planning for this is extremely important. Each case is different. I encourage you to talk with an advisor. You're welcome to reach out to my team if you have questions. Otherwise, thank you. Like and share the video, and have a great day.